What is corporate income tax? In this series, we're helping hustlers, entrepreneurs, and business owners understand the landscape of business and tax. Simply put, corporate income tax is a tax that registered companies in South Africa need to pay. It is currently sitting at 27%. In this video, we're going to cover what corporate income tax is, how it's calculated, how you're going to pay it, potential savings for your business, and what SARS expects. Let's get started. So the corporate income tax is 27% of the profits that you make in your business. Remember, if you're running your business as a sole trader or sole proprietor, it will be taxed in your personal income tax tables. But if you have a separate business that is registered, it is a separate legal entity liable for its own corporate income tax, which is the 27%. Now, 27% is not applied to every rand that your business makes. It is applied to the profits on your business. From a SARS perspective, it's called your taxable income. So your taxable income is the money that your business makes minus the allowable expenses. There's a difference between the expenses you may run through your business and what SARS would allow. So for example, SARS would not allow for a deduction of fines, for example. That would be termed an illegal expense, or expenses that are related to your personal life. So your corporate income tax is going to be 27% of the profit that your business makes. If you're running your business in your personal capacity as a sole trader or a sole proprietor, that tax becomes part of your personal income tax. You will not pay a separate corporate income tax. If you have a registered business that you operate your business through that has a Pty Ltd attached to it, then you will pay the corporate income tax on your profits. Now, the 27% is not 27% on every rand that your business brings in. It's 27% of your profit, or SARS calls it your taxable income. How do we get to this taxable income? So that's your revenue, or the money that your business brings in. You deduct allowable expenses. In your case, you call it expenses, and you get to a profit that becomes your taxable income. Now, the reason there's some difference between what you call profit and what SARS calls taxable income is because of the categorization of expenses. For example, if you're running your business from home in your home office and your rent is 10,000 rand, you cannot deduct the full 10,000 rand from your business expense. The allowable deduction there would be the percentage of your rent, which is based on the percentage of floor space that your office occupies. So if you have an office space within your home that occupies 20% of the floor space of your home, then you can deduct 2,000 rand from your business as a rent expense. So there are expenses that are not allowed, such as personal expenses, capital expenses like setting up your business, machinery, equipment, etc. But the expenses to repair, maintain your assets would be allowable expenses. Things like fines are illegal expenses, so they're not going to be allowable deductions from your business. So it's important that you keep an accurate record of the transactions that your business makes and you deduct these. So common expenses that are allowed are, as we discussed, your rent, employee salaries, your accountant fees, legal fees, as well as insurance and things like that. Your cost of materials, if you have any materials, your marketing, these are generally accepted as allowable deductions. So when you're running your business, you need to make sure that you keep these records for at least 5 years. So that is how your taxable income or your profits will be calculated. Let's run through a quick example. Your business makes R1 million. You deduct expenses of 800,000, but included in those expenses, you had deducted your full rent and your full personal expenses, which are then removed as not allowable, which means your allowable expenses could be something like 600,000, which means your business has a taxable income or profit of 400,000 recognized by SARS. and you would then pay 27% of that 400,000. So it's important to keep accurate records so you have legitimate deductions from your business, and you keep these records for up to 5 years. So your company has taxable income and you know that it's at 27%. Do you make one big payment at the end of the year? No. Well, how do you make payments on your corporate income tax? SARS uses the provisional tax system. Under this system, you will estimate your profits for the year and make 2 payments to SARS. You'll make a first provisional payment 6 months into your tax year and the second provisional payment at the end of your tax year. You can opt to make a third payment if your estimated profits were lower than your actual profits. Let's run it through the 2026 tax year. The tax year starts on the 1st of March 2025 and ends on the 28th of February 2026. 6 months in, that's at the end of August 2025, you'll make a first provisional payment. You will submit what they call an IRP6 through e-filing, and you'll estimate what your profits are going to be for the year, and you'll make the first payment, which is half of your corporate income tax estimate. Then at the end of 28 February 2026, you will estimate what your taxes are, and you'll make the second provisional payment, again through an IRP6 on e-filing. All right, so you've made provisional tax payments throughout your financial year. What happens after your company's financial year end? Well, it's time to finalize everything. You are required to submit an annual income tax return for your company through SARS, through e-filing, and a form called ITR 14. In this return, you will detail what your actual income was, what your actual expenses were, and based on this, you will calculate what your actual final corporate income tax is. The ITR 14, or your income tax return, will compare what your actual taxes are to the provisional taxes you made based on estimates and see what the difference is. If you underpaid on your provisional taxes, the taxes that are now owed on your income tax return, you might need to make the final payment. If you overpaid on your provisional tax, on your income tax return, you might be due a refund from SARS. Your income tax return is due 12 months from the financial year end of your business. So you're required then to make sure within 12 months after your year end, you do your annual financial statements and you submit your income tax return and make the final payments for your taxes. All right, so on to the good news. So SARS does offer tax relief to micro and small businesses. What does that mean? So let's start with small business. If your company or your business qualifies as a small business corporation, it will pay a reduced tax starting at 0% all the way up to 27%. So it'll be on a graduated or sliding scale with tax tables on it. The second one is turnover tax. Now, turnover tax is different in that it is aimed at micro businesses, so businesses that make less than 1 million rand every year. For example, if your business makes 300,000 in revenue, you would pay no tax at all. If your business makes 500,000 in revenue, you would pay 1,650. Turnover tax does have qualifying criteria. The qualifying criteria is similar to SBC, but it's different in that even sole proprietors, partnerships, closed corporations can qualify. But there are exclusions similar to SBC where your personal service providers are excluded. You must have more than 80% of your income cannot be derived from a single client. So let's recap. Your corporate income tax is a tax that companies in South Africa must pay. It's calculated as 27% of your taxable income. The taxable income is your revenue minus allowable expenses. For businesses that qualify as small business corporations, they will pay a lower tax rate. Small business corporations, generally speaking, make less than 20 million rand, have only individuals as shareholders, and those shareholders don't have shares in other companies. Micro enterprises could qualify to leave the corporate income tax system entirely and join the turnover tax system, where they pay even lower taxes. For corporate income tax, you make payments through the provisional tax system. You make 2 payments throughout the year and an optional 3rd payment after year end. So this may be overwhelming and seem complicated for you, but understanding these basic elements of the tax system will help you manage your business better and manage your taxes better. We help entrepreneurs and businesses in South Africa with managing their taxes. If you need help with your business, feel free to register for a free consultation where we can sit down and discuss your business and what works for your business. If you enjoyed this video, please like the video so other entrepreneurs just like you can find this content. You can also leave a comment and subscribe to the channel.